All right, we have more changes unfolding in the U.S. economy and the U.S. credit markets. Changes that have delinquencies in every sector for every type of borrower beginning to rise, and not just by a little, but by a lot. And the funny thing about this is just a few months ago, we heard the Fed come out braggadociously voicing success with their soft landing strategy, specifically citing lack of delinquencies or a leveling out of delinquencies as a measure for why their approach is working without causing undue pain to consumers and to businesses. Well, it looks like they need to eat their words, folks, because over the past few months, a whole lot has changed. But before we get started, if you're not already a subscriber of this channel, consider subscribing. It helps the channel out, and I appreciate your support. So something that we've been talking about since last year, and at times does feel like we're beating a dead horse with, is the topic of tighter lending standards. We've spoken about the risks and the definitive dangers with banks being all but forced into doing this, not to mention it being the most effective recession indicator you can find, in my opinion. A lot of people cite the yield curve as being the best way to predict a recession. Not here, folks, not with me. I put my money on loans, lending any day of the week, and the reason is because it can't deceive you. Unlike the yield curve, just look at the success rate of it. These dark shaded areas are recessions. Each time you see banks pull back on lending by around 60%, what happens? We fall into a recession. And the reason is because when you turn off the money spout in a system that relies so heavily on borrowing, you get all types of problems. From the obvious top end of the spectrum, making it harder for all of us, for all businesses, for all investors, for everyone and anyone to obtain a loan. But there's other downside effects to this as well, such as changing the terms of existing debt products, dialing back or outright removing promotional offers for things like credit cards and lines of credit. And that's important, by the way. Remember that as we get into what just happened with the release of these new delinquency numbers. But before we start to look at this, let's just get some facts straight, all right? A delinquency happens when borrowers miss their loan obligation payments. For credit cards, they define a delinquency as an account that's 60 days or more past due. Now, up until March or April-ish, delinquencies seemed to level out, which is what brought Jerome Powell to tout that fact as a success for why conducting these changes in policy, tightening financial conditions, is not only necessary, but can be done without causing undue harm to the economy. But he seemed to speak a bit early, as we're now seeing more and more borrowers fall further and further into delinquent status, and it's likely about to get much worse. There's two things I want to show you. First, just quickly, is this article that the Fed published on their website, the St. Louis Fed, that is, 3 weeks ago. They published this. And remember, this was before these new numbers had come out. So they saw all of this happening, this trend beginning to form, and decided to write this up. The title of the piece is Deja Vu, the recent rise in credit card debt delinquencies. The entire article is about the similarities to what we're seeing happen right now with borrowers being unable to pay back their loans to what happened a decade ago during the run-up. Key word, by the way, the run-up to the great financial crisis. Well, it's gotten a whole lot worse, folks. Before we look at the new delinquency numbers, just quickly look at what the Fed was warning about 3 weeks ago. What you want to home in on here is the orange line in this chart. What we're looking at is the percentage of people delinquent on their credit card debt by age group. What do you notice? Q1, which was the first spike that we saw in credit card delinquencies, came from young borrowers, which seemed to level out in Q2, hence when we heard Jay Powell mention this a few months ago. But look what also began to happen. The largest cohort, the orange line, ages 40 to 59, the more financially stable, reliable type borrowers, continued to fall further into delinquency through Q1 right into Q2. Now, again, this was only for the first 2 quarters of the year. Well, we have some new numbers. Moody's research put out a great report on this a few days ago, breaking it all down. Unfortunately, the report's proprietary, so I can't show it in this video like we usually do. But the Washington Post did summarize it, so let's take a look at that. They also interviewed Moody's chief economist, who gave some more insight into this. This was published late last week. It's titled Delinquencies Rise for Credit Cards and Auto Loans, and it could get worse with interest rates going up. More consumers have missed payments on household debt. Here's what they say. More Americans are falling behind on their car loan and credit card payments than at any time in more than a decade, a troubling signal of consumer stress as higher prices and rising borrowing costs are squeezing household budgets. The pain is most acute, they say, for lower income earners who have largely used whatever they managed to save during the pandemic with the help of government stimulus checks and breaks that they got through forbearance programs on rent and student loans. Then they go on and they quote Mark Zandi, Moody's chief economist, saying the following: the increase in delinquencies and defaults is symptomatic of the tough decisions that these households are having to make right now, whether to pay their credit card bills, their rent, or decide to buy groceries, which is what always happens, folks, right before things get really, really bad. Borrowers typically choose to miss what first? They choose to miss their credit card payments first. Then they choose their auto loans. And last resort is always mortgage payments. And it looks like we are further along than most people thought. Take a look at the newest numbers that they put out. These are the total active delinquencies by type of debt. So it's filtering out all the junk loans that have been charged off by these banks and by lenders due to severe delinquency. So this is current, from current active borrowers. What do you notice? Every one of these debt products are at their highest delinquency levels in a decade. Auto loans are even worse. In fact, worse today. More people are delinquent on their auto loans today than they were during the worst periods of the great financial crisis. The article goes on and says this: as the economy finds its post-pandemic footing, there are signs the hardship for millions of consumers will get worse before it improves. The average credit card interest rate already is at a record high of 20.6%, according to bankrate.com, appears likely to keep climbing though. All right, I have to stop one more time real quick. A lot of people don't recognize this, how ridiculously high typical credit card interest rates are. The average is 21%, but I work with a lot of debt shops, folks, who use our CRM, Snapforce CRM, and I see what these numbers really do look like, folks. They are much higher than 21% for a lot of people, especially lower tier borrowers. That's why you should never carry a balance on your card. Set them to auto pay and be done with it. I have multiple credit cards. Every single time I've gotten a new card, the first thing that I do is turn on auto billing and set it to pay the full balance each month. All right, let's continue. They write this: all of this is happening as student loan payments that were paused for more than 3 years are poised to resume in October. Sidebar, by the way, student loans are set to resume with payments in October, but the interest rate, or the interest, already began accruing on August 28th, last week. They go on and say, along with banks and other lenders, they've been clamping down on credit for months, a process that accelerated after the spring banking crisis sent shockwaves through the industry. That's right, folks, like we began the video off, how all of this, these delinquencies, a result of banks tightening their lending standards. It's a byproduct of them removing these promotional offers for credit cards, things like that. You ever notice when you look at a credit card offer sent in the mail to you or wherever, a lot of times you'll see them offering 0% APR balance transfers, things like that, which lets you transfer your credit card debt to another lender and pay 0% interest on your outstanding debt. That helps a lot of people. Well, those days are over, folks. They've been dialing those promotions back left and right over the past year. And to top it all off, we are finally seeing unemployment begin to rise. We spoke about it last video. Unemployment rate rose from 3.5% to 3.8% last month. It may not sound like a lot, but it is. And what you have to watch with these job numbers are the revisions. It's very likely we're going to see the number break upward by the end of the year. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Press the dislike button. Either way, I appreciate you watching.